All right, everybody. So, first thing with Google, and there's always, every time that we put a signal out on this, there are always some mistakes. Mistakes because there are two Googles. Okay? There's Goog with an L, like what I have up on the board. And then there's also Goog. Okay? With no L. They are slightly different in price, have different option values. So we are looking at Goog with the L on the end. Okay? So that's first and foremost. And if, I don't know that we're sending a signal out, guys. If we send a signal out, please follow it with the directions for Goog with the L. Okay? Can't emphasize that enough. Okay. So from a technical standpoint, before we look at option prices or anything here, you will see that we are up at some really big resistance, which is that all-time high almost a year ago, last July. This thing has clawed its way all the way back. Does that mean it can't go higher? No, of course it does not mean that at all. Okay, just something to point out. Paul, are you saying that facetiously? Okay, what did I say we are looking at? Which symbol? Which stock are we looking at? I don't think I can be any clearer. We are looking at Google with the L on the end. Okay. Stock is $12.85 basically. What is the expected move today? All right, Michael, I'm glad you think up. We're just looking at the magnitude of the move, not direction yet. Bob, how are you getting $52? 44 is really the right number-ish. So Bob, let me work with you. How are you getting 52? Okay, cool. So we're all in agreement. We got a $44 expected move. Okay. Stock is $12.85. No, it's not 11,285 like I have there. That's better. Okay, expected move. About $44 puts us an expected range then of 1240 up to 1330. Okay, going back to the chart here. Okay, there is maybe some support. I think there is some support at 1240. And if you ask me how, it's just because this was resistance. Okay, let me actually make this a little bit easier to read here. So right here, this was resistance right here at about 1238, which then became resistance again and then support. So there is, some, I would call that minor support there. And in terms of resistance to the upside, really nothing. Okay, so some support around 1240 and all-time highs above. Okay, let's take a look at an iron condor. Right around those expected move ranges. Okay, a little bit light. So the 1245, 1240, and 13 and a quarter, 1330 iron condor is about 2 and a quarter, which puts our expected moves also, or break evens, right in the range. Not out to the range of the expected move. So break even there would be 1242.75 up to 1327 and a quarter. Okay, just inside there. Probably wouldn't bother me so much if we could get a little bit more. Maybe 230, even 235, I'd probably consider that. Okay, now, let's look at something else here. Because I think on the upside, again, there's no resistance on the upside. But let's say we wanted to potentially do something just off of that support around 1240 on the downside. Is there anything that we could potentially take advantage of there? We always look at buying butterflies. What about selling a butterfly here? Well, I certainly don't want to sell a butterfly for garbage down there. Well, Kevin, are you looking for the up or down?
They need the credit card number for the order for the
Just
food.
tell them I'll call Nick.
Okay.
Okay, we'll look at that in a moment. Right now I'm looking for something around that support area on the downside. And there's just not going to be a ton of credit down there. And just to sell a put spread right in that area there, I'm not comfortable doing that. At all. Okay, let's look at, Kevin wanted to look at a broken wing fly. Okay, Kevin, now that you know the difference or you understand the difference, what strikes would you be looking at? Okay, Kevin, didn't you say that you wanted to look at an upside broken wing fly? Okay, so why are you looking at the 1240 put then? If we were looking, or if you were looking at an upside broken wing fly, we'd be looking at strikes to the expected move on the upside. So somewhere, targeting 1330-ish, right? Does everybody see that? So maybe something like, let's say 1315, 1330, 1335. Let's see how something like that looks. I mean, that's really cheap. Okay, but Kevin, that's completely different than looking at a broken wing fly to the upside. That's completely different. Okay, there are probably going to be some pretty cheap butterflies on the upside here. Anybody else have anything else you want me to put up here? So, David, or Christopher, something to consider. Okay, something to consider. When you make a statement like that, option volume favoring the call side. Okay? Option volume always favors the call side in Google. Not just today, not just yesterday. Always favors, historically. So just be careful when you look at something like that and say, oh, there's more calls being traded than puts. Well, there always are more calls being traded than puts in Google. Michael, a broken wing fly is a volatility neutral trade, so it really doesn't matter if vol is high or low. It's volatility neutral. Yeah, you were gone when I came back. Sorry. Thank you. Okay, if we look at an upside calendar, we could look at like the 1330. Something like that's going to cost probably about $3.25. Okay, I don't love that. It's obviously pretty good if you're in the sweet spot. I don't really love that. Paul, we can absolutely look at $2.50 Y. We're going to see the same sort of ratio. So let's take a look at that. Kevin, that's still downside. That's still downside, unless you're talking about calls. Which is the same thing as so that's the exact same thing as a put butterfly with the same strikes. It's the exact same thing. And I can show that to you. But let me put the $2.50 wide iron condor up here. and you can see it's really in the same boat. Actually, even a little bit worse. I see it as a little bit worse, Paul. So let me put the 12.42 half, 12.40 and 13.27 half, 13.30 iron condor. Let's say even for $1.05. Okay, that is actually a worse reward to risk. Unless you're looking at different strikes and different prices than I am. Michael, you're late. I was waiting for you. I'm not supposed to get that up there before you do. All right, so Paul, if we use those strikes, that's even going to be less. So you're using the same call strikes as me, but you're actually lowering the put side. One set of strikes. That's even going to be less credit. Now, it's going to extend your break even a little bit, but even if it's the same credit at $1.05, that still comes in at the same reward to risk, Paul. So you might want to calculate that out. I like the suggestions. I definitely like the suggestion. David, you can absolutely do a regular butterfly. They're always going to be cheap. Butterflies are always going to be cheap. Kevin, I understand that. All legs in the money, so you're looking at the call side. It's the exact same thing. Let me put it up here. Exact same thing as that put butterfly. Okay, let me just show you. You're looking at the 1240, 1245, 1250. Okay, that thing is going to cost you probably about $1.15, $1.25. Okay, and let me put up the reward, the risk chart on this. Okay, take a look at that and where your profit area is. And this is tomorrow. I'm not measuring this to the end of the week. I'm measuring this to tomorrow. And now look what if I put up the exact same strikes, the exact same butterfly, but on the put side, you're going to see it's the exact same graph. There you go. And that's because of this synthetic relationship that we always talk about, that calls are puts and puts are calls. All right, so I'm going to look further into Google here, guys. I really like the Iron Condor the best. However, we're not just going to do it just to do it. It's got to be at our pricing. And now this price, the midpoint has ticked up a little bit. Tell you what, I would send this out there at $2.40 right now, and if we get filled, that's great. And that's exactly what I'm going to do. I'm going to send this out at $2.40. I don't know that we're going to get filled. I don't think we are. But one thing that you have to watch closely here, guys, Google can obviously change a lot price-wise between now and the end of the day. So we don't want the stock to move all that much from here, because we want to have as close to the right starting point as we can get, right? Everybody hear me? Okay, so I'm going to put this out. Again, I don't know that we're going to get filled at the price we want to get filled at. And there are going to be very implicit instructions on this signal here, guys, as to the range that this is valid in and the pricing. I am putting also in the signal that it has to be Google, not Goog. What do you mean by short to put, Kevin? We're short a put and we're short a call. We're also long a put and long a call. This is a credit spread. We're selling a put spread and a call spread.